Meet Alex. He's 25 years old. He isn't rich. He doesn't know how to trade. He doesn't spend hours researching companies. But every Friday, right after he gets paid, he invests $100. Not $1,000, not his whole paycheck, just $100. 40 years later, Alex has a portfolio worth more than $1 million. But here's the surprising part. He only invested about $208,000 of his own money. So where did the other $900,000 come from? Let's find out. Alex isn't trying to find the next big company. He isn't glued to the stock market every day. Instead, he keeps things simple. Every single Friday, he invests another $100. Sometimes the market is rising, sometimes it's falling. Sometimes the news says it's the worst time to invest. Alex invests anyway, every single week. For this example, let's assume Alex invests in a broad market ETF. If he lived in Australia, that could be something like the Vanguard Australian Shares Index ETF, known as VAS, which owns shares in hundreds of Australian companies. If he lived in the United States, it could be an ETF that tracks the S&P 500, such as VOO or IVV. These are simply examples of diversified ETFs. The important point isn't which ETF Alex chooses. It's that he's investing in many businesses instead of trying to pick individual winners. Some of those companies pay dividends. A dividend is simply a payment that a company makes to its shareholders. Instead of spending those dividends, Alex reinvests every dollar. Those dividends buy more ETF units. Those new units can earn dividends too. And little by little, the snowball begins to grow. After the first year, Alex has invested $5,200. Has he become rich? Not even close. His portfolio is only worth a little more than what he invested. Honestly, it's a little disappointing. And this is exactly where many people quit. Because investing doesn't feel exciting. It doesn't feel life-changing. It just feels slow. But that's because compounding isn't designed to impress you in the beginning. It's designed to reward patience. 5 years pass. Alex has invested $26,000. His portfolio is worth around $31,000. Still, nothing spectacular. Most of the portfolio is still money Alex personally contributed. The investment growth is there, but it isn't obvious yet. Then something happens. The market suddenly falls. News headlines are everywhere. People are talking about a crash. Some investors panic. Some stop investing altogether. Others sell everything. Alex has a choice. Does he stop? Or does he keep investing? He keeps buying. Every Friday, just like always. Because when prices fall, his $100 buys more ETF units than it did before. While everyone else is focused on falling prices, Alex is quietly buying more ownership in great businesses. Eventually, the market recovers, and those extra units he bought during the downturn are now worth even more. 10 years have now passed. Alex has invested $52,000 of his own money. His portfolio has grown to around $75,000. Now something is changing. The gap between what Alex invested and what the portfolio is worth is starting to get bigger. His investments are beginning to do some of the work for him. The dividends are larger. Those dividends buy more ETF units. Those units earn more dividends. The snowball is rolling faster. A few years later, Alex reaches his first major milestone. His portfolio reaches $100,000. For the first time, investing feels different. Not because he's planning to spend the money, but because he can finally see years of consistency beginning to pay off. 20 years after he started, Alex has invested $104,000, but his portfolio is now worth around $228,000. This is where things become really interesting. The portfolio is no longer growing mainly because Alex is adding money. It's growing because the investments themselves are generating more growth. Every year, the dividends get larger. Every year, the portfolio has more money invested than the year before. And every year, compounding becomes more powerful. Then one year, something incredible happens. Alex contributes another $5,200. But his portfolio grows by even more than that. For the first time, his investments earn more money than he personally adds. His money is now working harder than he is. 30 years have now passed. Alex has invested $156,000. His portfolio has grown to more than $500,000. This is where many people underestimate the power of compounding. A 7% return on $20,000 isn't very exciting. A 7% return on $500,000 is. The bigger the portfolio becomes, the harder it works. Finally, 40 years have passed. Alex invested $100 every week. He ignored the headlines. He kept buying during good times. He kept buying during bad times. He reinvested every dividend, and he stayed consistent. In total, Alex invested about $208,000 of his own money. His portfolio is now worth around $1.14 million. Not because he found the perfect stock, not because he predicted the market, not because he got lucky, because he stayed invested. Now, does this mean everyone who invests $100 a week will become a millionaire? No. Markets don't move in straight lines. Some years will be fantastic. Some years will be disappointing. And future returns are never guaranteed. The figures in this video are simply an example based on a long-term average return. But the lesson isn't about reaching $1 million. The lesson is that small amounts invested consistently over long periods of time can become surprisingly large. Whether it's $20 a week, $50 a week, or $100 a week, the amount isn't the most important part. The habit is. Because the biggest surprise isn't that Alex ended up with more than $1 million. It's that most of that wealth was created in the later years. Which means the biggest mistake most people make isn't choosing the wrong ETF. It's giving up before compounding has enough time to do what it does best.